Alrighty, everybody, what is going on? Welcome back to another CyberX video breakdown. Today, we're going to be diving into post CPI. We're going to be discussing and talking about the total cryptocurrency market cap, how, as of time of recording, the total market cap is still down on the day, hovering underneath of yesterday's lows, even after a cooler CPI report. We're going to dive into all that, talk about the Middle East tensions, talk about the current market landscape. We're going to read thoroughly through our CyberX community report so that way everybody's up to date on the current market landscape and what to pay attention to in the coming days ahead. Hopefully, you guys have enjoyed these accurate updates, keeping you on the loop with what's taking shape. Before we dive into that, I want to bring a project to everybody's attention that inside the private CyberX community, we have been paying attention to for some time now. This is not financial advice. This is just to show you guys that we are actually investing into this asset and that we have been doing research on it. So that way, bringing it to your attention on the internet, you're not just thinking that we just randomly started talking about it because it's one of the top performers in the total cryptocurrency market cap right now for altcoins. So the asset that I want to bring to everybody's attention that watches CyberX, again, do your own personal research. This could or could not perform well. For me personally, on my investment into this asset, Lighter, I'm up about 84% from when I started dollar cost averaging in. Our research team had been doing research on this project since all the way back starting in February. And I messaged the private CyberX community back on February 11th, 2012. Here's that post. Here's that comment inside the private CyberX Discord in the Cypress analysis section where I tell individuals what I'm personally investing in. And you can see one of those investments was Lighter. Now, I did not catch the bottom of this trade. However, I am up on my current position, roughly about 84% at time of recording. I was getting in this area between $1.20 and $1.27 back in the end of February. And now price is currently hovering at $2.37. So I thought that in light of this most recent bear market, we do need to start to look for projects that are still performing well because they have good tokenomics. And Lighter is one of those projects. Now, if you guys want a safe place to do research on Lighter, again, head over to cyberxtrading.com because inside our private CyberX Discord, our researchers have been dropping gems on Lighter since all the way back beginning of the year in February. And you can see these are just some of the podcasts and some of the panel discussions that have been released on Lighter that our researchers have shared for our community members that go into detail and talk about and discuss Lighter's price action, huge gems from individual representatives that work at Lighter, so on and so forth. So this one is a really great video. This one was shared back in March in our community here. And just to show you guys, 45 views 4 months ago, tokenomics on Lighter. We have an individual representative from Lighter talking and discussing about this. And, it just goes to show what people are and are not paying attention to. You can see now, as of time of recording today, Lighter's price action is looking a lot different from the rest of the total cryptocurrency market. Now, I'm not sitting here saying to go out and invest and chase the price action. I was lucky enough to be aware of this project via our CyberX researchers, which is why it's such a great time to be a part of a private community like the one that we have here at CyberX, because our researchers are always sharing gems like this inside the crypto research section. All right. So do your own personal research. Go check it out. Go look at what Lighter is. If you want a safe place to do research, head over to cyberxtrading.com. You guys have direct access to our CyberX research section where all these documents, all these panel discussions, and all these projects are shared from our CyberX research team. So this is one of the top performing investments that I've had so far in 2026, given light of the most recent downturn in the total crypto market. So with that being said, taking a look at the total crypto market cap, right now, on the daily time frame, we are trading below yesterday's highs. Right now, the market is down about $922 million. It was down about $4 billion on the day, currently trading at around 2.16 trillion post CPI. So what is happening in the market landscape? Why is the market down, even though we saw a cool inflationary report? Let's break that down for you all in detail. Stick around for the entirety of this. Again, this is the boring stuff that nobody wants to pay attention to, but everybody should. And if you want access to these handwritten reports, jump over into the CyberX private community to keep yourself updated so you're not manipulated into believing something that's not going to happen in crypto until this underlying fundamental backdrop starts to change in support and in favor of risk on sentiment. So, today, markets received what should have been a constructive inflation report Wednesday morning. But the reaction across risk assets tells a much more complicated story. July CPI showed that inflation continued to cool, yet crypto failed to attract meaningful buy pressure. The total crypto market struggled to push through yesterday's highs and is currently trading lower on the day. While many major altcoins continue to take a beating, XRP included, instead of investors treating softer inflation as an immediate green light to add risk, markets appear focused on what comes next. Elevated oil prices, uncertainty surrounding the Strait of Hormuz, unresolved US Iran negotiations, persistent inflation pressures beneath the headline numbers, and Federal Reserve that may have delayed its next rate hike rather than abandoned tightening altogether. The July CPI report was essentially right in line with expectations. Headline inflation increased just 0.1% month over month, while the annual inflation rate slowed from 3.5% to 3.4%. Core CPI, which excludes volatile food and energy prices, increased 0.2% month over month, while annual core inflation eased from 2.6% to 2.5%. On the surface, this is actually encouraging. Inflation has now slowed for the second consecutive month, and the 2.5% core reading matches the post pandemic lows reached earlier this year. Shelter increased only 0.1% and accounted for roughly two-thirds of the monthly increase in headline CPI. Gasoline prices also declined 2.9% from June, helping pull the overall inflation number lower. But there is an important distinction between inflation cooling and inflation being defeated. The Federal Reserve's target remains 2%, meaning inflation at 3.4% is still well above where policymakers ultimately want it. More importantly, today's report was largely expected, meaning it was already priced in. Headline CPI came in at 0.1% against 0.1% expected figure. Annual CPI printed 3.4% against the same thing, 3.4% expected. Core CPI, same thing, came out expected at 0.2%, and annual core CPI printed at 2.5% against the expected reading of 2.5%. In other words, there was no major downside inflation surprise for markets to aggressively reprice around. Investors received confirmation that inflation is moving in the right direction, but not necessarily enough evidence to completely change the broader monetary policy outlook, which we know has been relatively hawkish as markets have been pricing in rate hikes instead of rate cuts. One of the biggest reasons markets remain cautious is that CPI is backward looking. Today's report tells us what happened to consumer prices through July. Markets, however, are attempting to price what inflation could look like in August, September, and beyond. That is where oil becomes extremely important. Gasoline fell 2.9% from June to July, helping suppress the latest CPI reading, but gasoline prices remain roughly 25% higher than a year ago. Energy prices are still approximately 14.7% higher year over year, while gasoline is roughly 24.6% higher. Airline fares increased 2.2% in July and are substantially higher from a year earlier, demonstrating how higher energy and jet fuel costs can eventually work their way through other parts of the economy. This is why the market cannot simply look at today's 3.4% inflation number and conclude that inflation and the problem with inflation is over. Crude oil remained volatile around $83 per barrel on Wednesday as markets continued trying to determine whether the United States and Iran can reach an agreement surrounding the Strait of Hormuz. President Donald Trump stated that the United States has total control over the strait while negotiations remain deadlocked. The increasingly confrontational rhetoric has created additional uncertainty. Remember, markets don't like uncertainty over whether the critical shipping route can be reopened under a sustainable agreement. At the same time, there have been conflicting signals. Pakistan's defense minister indicated that Washington and Tehran may be close to some form of an arrangement, while reports suggest negotiations involving Iran and Oman have reached an advanced stage. This leaves markets caught between two dramatically different outcomes. A credible agreement that reduces tensions and restores normal shipping through the strait could pressure oil lower and reduce future inflation concerns and potentially provide relief for risk assets. Continued deadlock or renewed escalation could do the opposite. Higher oil would feed directly into gasoline transportation and shipping costs and eventually work its way into a much broader range of goods and services. The market is therefore not simply trading today's CPI report, it is trading the possibility that today's improvement could be temporary. Interestingly, U.S. crude inventories increased by approximately 17.4 million barrels last week, the largest weekly increase since early 2023. Under normal circumstances, such a large inventory build could create significant downward pressure on oil. But the fact that crude remains elevated demonstrates how much geopolitical risk continues to influence energy markets. Another concern is that inflation isn't exclusively an oil story. Groceries declined 0.1% month over month in July, but remain approximately 2.7% more expensive than a year ago. Clothing also increased only 0.1% during July, but it's roughly 3.9% higher year over year. Computer prices jumped. Services inflation is also important. Healthcare, restaurant meals, and vehicle maintenance costs increased approximately 3% year over year. These categories are not particularly sensitive to short term movements in gasoline or crude oil, suggesting that portions of inflation remain embedded deeper within inside the economy. The United States has now experienced inflation above the Fed's 2% target for more than 5 consecutive years. That history makes policymakers much more cautious about declaring victory after a few favorable inflationary reports. On top of that, we have tariffs that are creating another layer of inflationary pressure. Businesses are also continuing to absorb higher costs related to tariffs, raw materials, electricity, transportation, and supply chains. Those costs eventually have to go somewhere. Companies can absorb them through lower profit margins, reducing hiring and investment, or pass them on to consumers through higher prices. None of those outcomes are particularly attractive for markets, especially risk assets. So, this may be the most important piece of today's market reaction. The softer CPI report reduces pressure on the Fed to immediately raise rates, but the interest rate market has not, I repeat, has not yet completely removed another hike from the equation. Expectations have instead shifted further down the calendar. Following the CPI, markets priced in roughly a 61.9% probability that the Fed holds the current 3.50 to 3.75% rate range at the September 16th meeting, compared with approximately a 38.1% probability of a 25 basis point increase. Just 2 days earlier, September was much closer to a coin flip. That sounds bullish until we move further along the curve. By the October 28th meeting, markets were assigning approximately a 62% probability to the 3.75-4% range, i.e., a rate hike, effectively implying that the market still believes another rate hike becomes increasingly likely by Halloween. So, we ideally need for risk sentiment to come flourishing back into the picture. We need this percentage probability to come down as well, along with the December rate hike probability to come down also. By the December 9th meeting, the 3.75%, 4% range carried approximately a 95% probability, with additional probabilities assigned to rates moving even higher. So we need to see both of these percentages come down in the coming weeks ahead if we want to see risk sentiment flourish. That is a critical distinction. The market has not necessarily removed another rate hike, it has largely just pushed the timing of that hike further down the calendar. The destination hasn't changed nearly as dramatically as the timing. For risk assets, that matters tremendously. Higher interest rates keep financial conditions restrictive, increase borrowing costs, support higher treasury yields, and make safer yield producing assets more competitive against speculative investments like crypto and stocks. That environment can continue putting pressure on growth stocks, crypto, and particularly higher beta altcoins. Primarily, we're seeing the bleed out of crypto. Nasdaq, S&P 500 have been supported by the AI trade, and crypto does not have that backdrop right now. On the Federal Reserve side, being still deeply divided, this is also adding another layer of uncertainty to the current market conditions. The Federal Reserve officials themselves still remain divided over the appropriate path forward. Roughly half of policymakers support raising borrowing costs against this year, while another group believes current rates are already restrictive enough to gradually return inflation at 2%. Today's CPI report strengthens the argument for patience. Core inflation moving towards 2.5% gives the Fed evidence that the underlying inflation pressures are cooling, even while energy remains elevated. However, the Fed also has to consider whether another oil shock, tariff-related price increase, or rising inflation expectations could reverse that progress. This creates an uncomfortable environment for markets because there isn't a clear policy trajectory. Investors aren't deciding between an obvious hiking cycle and an obvious easing cycle. They are attempting to determine when or whether additional tightening becomes necessary, depending on the incoming data. Remember, the markets do not like uncertainty. So, what do we need to pay attention to in the coming days ahead? PPI is now the next major catalyst. Thursday's producer price index becomes extremely important because it can either confirm or challenge the message delivered by CPI. Headline PPI right now is expected around 0.2% month over month and 4.9% year over year, compared with a 5.5% reading previously. Core PPI is also expected around 0.3% monthly and 4.2% annually, compared with the previous reading of 4.7%. A softer than expected PPI would reinforce the idea that inflationary pressures is genuinely cooling throughout the economy and could push September rate hike expectations even lower. Remember, they're currently trading in the 60 percentile range. We need to see that come down. A hotter PPI report, of course, particularly within the core components, could produce the opposite reaction. Markets could begin questioning whether July CPI represented genuine disinflation or whether falling gasoline temporarily masked underlying price pressures. That could quickly pull September back towards the much more evenly divided rate probabilities markets were pricing in earlier this week. We also have consumer inflation expectations, which could be even more important, with Friday's preliminary University of Michigan Consumer Sentiment Survey adding another major piece to the puzzle. 1 year inflation expectations are currently around 4.2%, while the 5 year expectations sit around 3.3%. Those numbers remain far above the Fed's 2% target. Inflation expectations matter because they can eventually become self reinforcing. If households believe prices will continue rising rapidly, they may demand higher wages or accelerate purchases. Businesses expecting higher future costs may then rise prices preemptively. So, why crypto is not responding to the cooler CPI? This brings us back to what we are currently seeing across crypto. Despite CPI coming in exactly as expected and annual inflation cooling for the second consecutive month, crypto has failed to attract meaningful buying pressure. Buyers were unable to push through yesterday's highs. The broader market is currently lower on the day, and many major altcoins continue experiencing significant selling pressure. That lack of response matters. A genuinely bullish market typically takes favorable macroeconomic information and uses it as fuel for a continuation. Instead, right now, crypto received a softer inflation environment and still struggled to generate sustained demand. This suggests investors are looking beyond the headline CPI number. The market still has to digest PPI, Fed commentary, retail sales, consumer sentiment, and inflation expectations in the coming days ahead, while simultaneously monitoring crude oil, the Strait of Hormuz, and negotiations between the United States and Iran. Until those risks begin resolving, which they could in the coming months ahead, institutions may have little reason to aggressively increase exposure to speculative assets for the time being, again, until the current environment changes. So, to wrap this up, today's inflation report was constructive, but it did not eliminate the problems currently weighing on markets. So, hopefully, you guys enjoyed today's video breakdown. Very quick, fast to read, just going thoroughly through what it is that we need to be mindful of and pay attention to in the coming days ahead, why market sentiment is down. Remember, don't believe the false hopium and hype out there that exists. Understand these underlying fundamentals and understand the dynamics that act as tailwinds or headwinds on risk asset prices that you invest your hard-earned money on. If you guys want access to these detailistic reports that we give to the private community members, head over to xrpxtrading.com. You guys have direct access through our Discord in our fundamental section, where every single day these announcements are dropped, whether it's Mr. Man's Atlas report or whether it's my hand typed out report. You guys have direct access to updated fundamentals, where every single day we keep you in the loop with what's happening in the current market conditions. We'd love to have you on the team. With that being said, many blessings to you guys and gals. Be cognizant, be aware out there. We'll pay attention to PPI and the rest of the market data that we get the remaining portions of this week. I'll make sure that I give you guys an update as we head into the weekend on XRP, Solana, and Canton's price action. Nothing has substantially changed from yesterday's update. Again, smash that thumbs up button, subscribe to the platform if you enjoyed today's brief update, and I'll see you all in the next video breakdown.